Okay, let's face it. In a world absolutely overflowing with information, trying to keep up can feel like, well, trying to drink from a fire hose, right? One minute you're reading about AI, the next it's global markets doing something crazy, and then suddenly an age-old asset like gold is making headlines again. How do you possibly cut through all that noise and truly understand what's actually happening, what really matters, and maybe most importantly, why it matters to you? Welcome to the deep dive. We're your shortcut to being genuinely well-informed. What we do here is take your sources, the articles you're seeing, the research, we add our own notes, and we unpack it all. We distill the most relevant insights, hopefully without any of the overwhelm. Our whole mission, to give you those aha moments, connecting the dots across topics that might seem totally unrelated at first glance. So today, we're embarking on, I think, a really fascinating journey. We're diving into 4 powerful trends that are genuinely reshaping our economic landscape. We'll kick things off exploring the high-stakes chess match among the titans of AI and the surprising regulatory twists trying to keep up with them.
Then we'll shift our gaze south, way south, to discover why Mexico's stock market is suddenly catching fire. It's drawing some serious global attention. After that, we'll dive into a really provocative forecast about gold, its potential to hit unprecedented highs, but, and this is key, only if certain, very specific conditions unfold. And finally, we'll look at how gold itself, this ancient asset, is actually stepping into the digital age, sort of reimagining its role in modern finance.
It's easy to look at these 4 topics, AI, Mexico, gold, digital assets, and think, okay, what's the connection? But what connects them is actually pretty profound. Each one highlights these crucial shifts in how value is being created, how it's protected, and how it's exchanged in our, well, rapidly evolving modern economy. Our goal for you today isn't just about laying out facts. It's about connecting these threads, giving you the context, the deeper insights that make this knowledge not just stick, but genuinely useful for understanding your world.
All right, sounds like a plan. Let's unpack this and dive right in.
The AI revolution's big players and their regulatory game.
Okay, first up, AI. The AI era, there's no doubt it is a battleground. You've got these tech titans fiercely vying for market dominance, and it's creating these huge ripple effects across, well, pretty much every industry imaginable. And all the while, you have regulators just scrambling, trying to keep pace with innovation that often feels like it's moving at light speed. It feels less like a traditional chess match with established rules, and maybe more like a game where the board, the pieces, even the rules themselves are constantly being rewritten, almost in real time.
That's a great analogy. It captures the dynamism and, frankly, the uncertainty perfectly.
Yeah.
1.1 Market dominance and strategic shifts. The tech titans AI chess match.
So let's start with one of the biggest players, a real behemoth, Google, or rather its parent company, Alphabet. They recently scored what many are calling a massive win in a major antitrust case that was brought against them. The court ruled they don't have to sell off their incredibly popular Chrome browser. And crucially, they can keep paying Apple that staggering $20 billion a year to keep Google as the default search engine on iPhones. On the surface, expert, that sounds like an almost total vindication for them, right? A huge victory to maintain their dominance in search.
It absolutely felt like a nearly status quo outcome, especially for their core search business model. Think of it like, I don't know, a star athlete getting to keep their signature move and their winning strategy completely untouched, even after intense scrutiny and a major challenge. This ruling effectively preserved Google's foundational position in the search market, which, let's be clear, is still the cash cow funding their vast operations.
Right.
If the outcome had been different, say a forced breakup of Chrome, that would have been absolutely transformative, monumental.
Okay, so it preserved their core business, their cash cow. Was there any concession they had to make at all, or was it really just a clean sweep for them?
Not quite a total walk-off home run, no. There was a small concession. Google will have to share some limited search data with competitors, but, and this is really critical to emphasize, this is search query data, not their incredibly lucrative and proprietary advertising data. That's where the real money is made, and that remains untouched. Furthermore, it's described in the ruling as a one-time measure. So it feels more like a tactical adjustment, a slight nudge, rather than a fundamental shift in their competitive landscape. It's like a small pebble tossed in the pond, maybe not the tsunami some competitors were hoping for, its actual impact on competition. Honestly, that remains to be seen.
Interesting. But even Google, right, with all its power, all its resources, and these recent regulatory wins, they still face what feels like almost existential challenges from the new kids on the block. We're talking about these new AI search tools like Perplexity, offerings from OpenAI, which seem to be fundamentally changing how people find information. Instead of just typing keywords and sifting through a list of blue links, users are now asking complex questions, often in natural language,
and getting a summarized, concise answer directly. This feels like a real paradigm shift, doesn't it? Moving from just discovering information to directly receiving answers.
It absolutely is a paradigm shift. And you're right, Google isn't just sitting idly by watching this happen. Their own AI model, Gemini, is performing incredibly well across various benchmarks and applications. They're demonstrating significant internal capabilities. But what's even more fascinating, I think, is their reported development of a custom Gemini model specifically tailored for Apple. This really highlights two things. One, the intense competitive pressure in the AI space, and two, the pragmatic potential for these surprising collaborations, even between huge rivals when it comes to embedding foundational AI across major platforms. It's a really shrewd move, ensuring their technology stays relevant no matter whose hardware it ultimately runs on.
Right, keeping their fingers in many pies.
Mhm.
So speaking of Apple, they're often perceived, rightly or wrongly, as being maybe a step behind in this rapidly accelerating AI race. They certainly seem to be feeling the pressure, especially after the huge splash OpenAI made with ChatGPT.
Yeah.
How are they trying to catch up? What's their play?
Well, Apple seems to be pursuing a very clear two-pronged strategy to counter that perception and really bolster its AI capabilities. First, they are internally developing their own AI-powered web search tool, specifically designed for Siri, to compete directly with offerings from OpenAI and others. That's the internal path. Simultaneously, though, they are exploring that potential partnership we just talked about, leveraging Google's Gemini model. This suggests a very intelligent hedging strategy. They're willing to develop internally or leverage external strengths if it gets them to market faster, more effectively, and maybe minimizes risk in this incredibly volatile, fast-moving landscape.
Okay, so they're not putting all their eggs in one basket. That hedging makes a lot of sense in a space changing this quickly. But doesn't this also introduce potential complexities? Or maybe even a loss of their signature control over the user experience if they end up relying on external foundational models from, say, Google?
That's a crucial point, and it gets to the heart of Apple's philosophy. However, Apple reportedly believes that these foundational AI models, the core intelligence engines, could eventually become commoditized, meaning they might become standard, almost like utilities, easily available tools, much like cloud computing infrastructure or even operating systems are today. Now, if this belief proves true, it means Apple can focus its immense resources on what it arguably does best, creating seamless user experiences, integrating the best available AI, whether built in-house or sourced externally, and leveraging its incredibly powerful ecosystem. The real aha here is understanding that Apple might be betting on the interface, the user experience, and the ecosystem being the ultimate differentiator, not necessarily being the sole innovator of the core AI engine itself. That's a strategic bet that could fundamentally reshape the AI landscape if other players are forced to compete on Apple's terms user experience.
That's a really shrewd way to think about the long-term game, playing to their strengths. But even as they navigate this complex AI landscape, Apple's incredibly lucrative services business, the engine of its recent growth, really is facing a very different kind of challenge. Significant regulatory pressure. We're seeing this from both the European Union and courts in California targeting things like the App Store.
And this matters immensely. Apple's services segment isn't just big. It generates massive, high-margin revenue and profit. It's been the key growth driver. So regulatory constraints here could deeply impact not only their revenue streams, but perhaps more critically, their historical control over their carefully cultivated ecosystem. That control, from the App Store rules to proprietary software, is an absolute cornerstone of their business model and a key differentiator. Any significant erosion of that control could have really far-reaching effects on their profitability and market position.
All right, let's shift gears slightly to a company that, honestly, the valuation just stopped me in my tracks when I saw it in the sources. OpenAI. They've emerged as an undeniably dominant force, valued at an astounding $500 billion, which is just mind-boggling for a company that, in the grand scheme of tech history, feels relatively new on the scene. And their flagship product, ChatGPT, boasts over 700 million weekly users. That's more than double the entire population of the United States using it every week. The scale of that adoption is just unprecedented.
Their growth truly has been meteoric. It's redefining what's possible in terms of user reach and market capitalization for a company that's still, relatively speaking, quite young. And they're not just resting on ChatGPT's laurels either. They're investing incredibly heavily in product development, including making strategic acquisitions like snapping up a product testing startup for a reported $1.1 billion. This kind of aggressive acquisition shows how quickly these companies are trying to build out their capabilities, accelerate their innovation cycle, and really secure their lead in this rapidly evolving market. It's not just about building, it's also about buying the best existing solutions and talent to stay ahead of the curve.
And while these giants, Google, Apple, OpenAI, are duking it out for the top spots, it's important to note that new players are also making significant waves. It proves the AI space isn't just a 2- or 3-horse race. U.com, for instance, recently secured $150 million in funding, valuing them at a respectable $1.5 billion. What's their specific angle? What's their niche?
Yeah, U.com is carving out a really critical, specialized niche. Instead of trying to be everything to everyone, like a general search engine, they're focusing on building search indexes specifically designed for large language models, LLMs. Think of those powerful AI engines like the ones behind ChatGPT. U.com is essentially becoming the fuel provider of real-time, up-to-date web data to enterprises using these LLMs. They're ensuring that those AI models aren't just intelligent in a vacuum, but also current, relevant, and accurate based on the latest information on the web. This isn't just some side project, it's foundational infrastructure for the next generation of enterprise AI applications, and a very smart place to position themselves within the broader ecosystem.
That makes sense. And then there's another significant player, Mistral, valued at an impressive $14 billion. That really shows the depth of talent and innovation blooming beyond just the established household names. The competitive landscape is clearly far broader than just the big three.
Absolutely. The pace of innovation across the board is just remarkable. 1.2 AI's ripple effect beyond core tech, from online shopping to energy.
Now, AI isn't just confined to these core tech companies and search engines, is it? Its ripple effect is transforming everyday businesses in some really profound ways. Take eBay, for example, a platform many of us use. They're apparently using AI quite extensively now to dramatically improve product listings, recognize items just from images, and personalize search experiences for their millions of users.
Oh yeah, this is a fantastic real-world application of AI that directly impacts user experience. For sellers, imagine how much easier it makes listing items. You just take a picture of something you want to sell, and boom, AI can instantly help categorize it, suggest relevant descriptions, maybe even recommend an optimal starting price based on similar listings. It removes a lot of friction. And for buyers, it drastically improves the efficiency of discovering exactly what they're looking for. Maybe it's a specific rare comic book or a vintage jacket in a particular size and color. AI helps surface those needles in the haystack. It personalizes the entire e-commerce experience, making it smoother, faster, more intuitive for everyone involved. Ultimately, that reduces friction and should increase transactions.
Okay, that makes total sense for e-commerce. But here's where it gets truly unexpected, almost bordering on sci-fi, reading through the sources. Rolls-Royce, yes, the luxury car and, perhaps more relevantly, jet engine maker. They are now making a significant push into something called small modular reactor technology, or SMRs. On the surface, what on earth does building small nuclear reactors have to do with artificial intelligence?
It sounds completely unrelated at first, right? But there's a direct critical connection that's absolutely fascinating. AI data centers, the massive, power-hungry physical infrastructure that powers this entire AI revolution, consume an exponentially increasing, truly staggering amount of energy. We're talking about energy demands that traditional power grids are struggling to keep up with. Rolls-Royce sees a massive market opportunity here. They aim to meet this exploding energy demand with their SMRs, which are essentially compact, factory-built nuclear power plants. These SMRs offer a powerful, reliable, and importantly, low-carbon energy solution that can potentially be deployed relatively quickly and closer to where these massive AI operations need the power most. It's an unexpected but incredibly logical link between cutting-edge AI development and the future of sustainable, large-scale energy infrastructure. It really points to the fundamental shift AI is causing, not just in computing, but in global energy demands.
Wow, that's
Yeah.
that's a connection I definitely didn't see coming. The energy footprint of AI is clearly a major emerging challenge. 1.3, the shifting regulatory landscape,
Yeah.
navigating a new frontier.
Okay, let's circle back for a moment to that Google court ruling we started with. As you said, it was widely hailed as a huge victory for the company, effectively letting them avoid that forced breakup of their core search business. But the judicial caution demonstrated in this case is actually a really key element for understanding the broader regulatory environment surrounding big tech right now. The judge specifically acknowledged that generative AI is rapidly transforming the market dynamics. That's crucial context. And the court was explicitly careful, stating it didn't want to issue a ruling that would unduly disrupt markets, reroute money flows or stifle innovation, especially in an industry undergoing such rapid and fundamental change. It signals a more measured approach, suggesting that regulators, or at least the courts, are acutely aware of the potential for unintended negative consequences when intervening too heavy-handedly in these highly dynamic tech sectors.
So this measured approach, this caution, could potentially set a positive precedent for other major tech companies facing scrutiny, maybe even Apple with its App Store challenges. It sounds like regulators might be becoming more cautious about radical interventions in these rapidly evolving tech markets. Like they're trying not to accidentally throw the baby out with the bathwater, even while trying to address concerns about market power.
It's a very plausible interpretation, exactly. However, as we discussed earlier, while Google avoided the breakup, they were ordered to share that specific, limited search data, again, critically, not their ad data with competitors, framed as a one-time measure. This immediately raises an important question for us and for the industry. How effective will this relatively limited data sharing truly be in promoting meaningful competition? Especially in a market utterly dominated by such sophisticated algorithms and massive proprietary data sets built over decades. Definitely a test case for sure, but its long-term impact on actually leveling the playing field, that's still a very open question.
Right. And the competition, as we know, isn't just for market share or technological superiority. There's also this fierce talent war for brain power raging across the entire AI sector.
Absolutely. It's intense. Reports indicate that even a powerhouse like Apple, traditionally known for attracting top-tier talent, is apparently losing talent to key rivals like Meta, OpenAI, and Anthropic. This vividly illustrates the intense pressure and the incredibly high demand for specialized AI experts across the industry. Even for established tech giants with incredibly deep pockets, acquiring and, just as importantly, retaining top AI researchers and engineers is proving to be a monumental challenge. It's almost a zero-sum game for the specific kind of human capital right now, and those companies that can attract and keep the best minds will undoubtedly have a significant edge in leading the next wave of AI innovation.
Interestingly, some of these tech companies aren't just battling each other or regulators. They're also actively engaging with government in perhaps surprising ways. ServiceNow and Microsoft, for example, are reportedly offering significant discounts. We're talking up to 70% of their AI tools and software, specifically to federal government agencies.
Oh, this is a highly strategic move. Plain and simple. It's designed to secure substantial market share within the lucrative and very sticky public sector. Now, while they might take a short-term hit on margins by offering such deep discounts, the long-term rewards of embedding their technology deeply within vast government operations could be absolutely massive. It provides a stable, predictable, long-term customer base. It helps set industry standards for how government utilizes these tools. And it essentially locks in a powerful client for potentially years, if not decades, to come. It's a classic land and expand strategy executed brilliantly. And, looking back historically, some experts who analyze these big tech investigations suggest that many of them have often amounted to nothing significant in the long run, at least from an investor's perspective. In fact, they argue these periods of intense regulatory scrutiny frequently became great buying opportunities for investors who are willing to brave the negative headlines and the perceived risk.
That's a really fascinating historical perspective. It suggests that while regulatory scrutiny is certainly high right now, and it absolutely warrants attention, it doesn't always lead to major company-altering market upheavals for the biggest, most entrenched players. There seems to be a certain resilience built into these tech giants.
Indeed. And there's also this ongoing discussion, sort of a parallel track, about encouraging open source AI development as a different kind of approach to regulation. The idea here is, instead of trying to break up dominant companies after the fact, which is often difficult, slow, and legally complex, maybe fostering an ecosystem where smaller players can innovate using shared open source foundational AI models could naturally prevent excessive market concentration and spur competition from the ground up. It's a more proactive, perhaps less adversarial regulatory philosophy worth watching.
That's a really interesting alternative approach. 1.4. So what does this all mean? Okay, let's try to bring this first big topic together for our listener, thinking about AI's regulatory landscape, the intense competition, the talent wars. What's the core message or maybe the most pressing implication for you?
Well, if we connect all these threads to the bigger picture, it's crystal clear that the AI era is defined by these major tech companies aggressively expanding and defending their dominance. They're doing this through rapid innovation, yes, but also through strategic acquisitions and savvy legal maneuvering. Meanwhile, regulators are in this constant, difficult struggle to find that delicate balance. How do you foster fair competition without inadvertently stifling the very innovation that's driving this incredibly dynamic field forward? So, for you, the listener, I think the key takeaway is that this inherent tension, this push and pull between innovation and regulation, between market consolidation and fostering competition, is going to continue to define the AI industry for the foreseeable future. It makes it a space that's absolutely ripe with both incredible opportunity but also potential disruption. It's definitely not boring.
Not boring at all. Okay, that's a great place to pause on AI for now.
Mexico's stock market, a southern surge. Why you should be paying attention.
We've just seen how the titans of AI are kind of reshaping value and power, primarily in the digital realm. But value creation, of course, isn't just about silicon and algorithms. Let's shift our gaze south now to a really fascinating economy where a confluence of factors, geopolitical shifts, technological modernization, seem to be igniting a surprising surge in the Mexican stock market. It feels like a different kind of chess match playing out, but on a very tangible and right now very exciting board, 2.1A market on fire. So let's pivot to something that should definitely catch the eye of investors, the Mexican stock market. It has been on an absolutely incredible run this year. We're seeing key indices like EWW and the IPC rising by over 30%. In dollar terms, that's an outstanding performance that definitely turns heads globally.
Absolutely. When you see that kind of sharp, sustained surge, it's like maybe a small engine that was idling suddenly just roaring to life. It's not just puttering along, it's genuinely outpacing many larger, more established economies right now. That kind of move signals that there are significant, powerful underlying forces at play, fundamentally changing the dynamics of that market. It's a momentum you simply can't ignore if you're looking globally.
Right, 30% plus is hard to ignore anywhere. 2.2. What's fueling this growth? The why behind the surge?
So what's behind it? Well, what's truly fascinating here is a significant shift we're seeing in international investment patterns. For about the last 5 years or so, global investors heavily favored developed markets, think the US, Europe channeling massive amounts of capital there, chasing tech growth and perceived safety. But now we're observing a deliberate, sustained rebalancing of global portfolios. Assets are increasingly shifting back into emerging markets. This isn't just a minor tweak. It seems to be a strategic reallocation of capital on a global scale, as investors actively seek new avenues for growth and perhaps better valuations.
And in this grand rebalancing act, Mexico is clearly being seen by many as offering very good value. Which basically means investors feel they can acquire attractive companies, good assets, at relatively lower prices compared to what they might be seeing in more mature, sometimes arguably overvalued, markets elsewhere. It's a classic hunt for undervalued opportunities playing out.
Exactly. And critically, it's not just foreign hot money pouring in, which can sometimes be fickle and leave just as quickly. We're also seeing large Mexican local funds, pension funds, institutional investors within Mexico significantly increasing their investments in their own domestic market. This internal confidence, this domestic bid, is a really powerful signal. It indicates a potentially more robust and sustainable growth trend than if it were purely driven by external investment alone. It suggests a belief from within the country that these opportunities are genuinely strong and have long-term potential.
That's a key point, local money believing in the local story. 2.3 tech transformation of the exchange. Bring it up to speed. Now, this surge isn't just about money flowing in, is it? It's also about a fundamental modernization of the market's infrastructure itself, making it easier and safer for that money to flow. The Mexican Stock Exchange, the Bolsa Mexicana de Valores, is apparently undergoing a massive technological upgrade, using NASDAQ technology for all its core systems. This isn't just a small tweak. This sounds like a full-scale overhaul.
Precisely. And when we say all systems, it really means everything. It includes the core trading engines where the buy and sell orders actually meet and execute, but it also extends right through to the complex, often unseen, but absolutely crucial post-trade operations. That's things like settlement, making sure the money and the securities actually change hands correctly after a trade clearing, which manages risk, and handling things like dividend payments. It's genuinely like upgrading an entire city's infrastructure from old, maybe unreliable copper wires to cutting-edge fiber optics across the board. It makes the whole system faster, more reliable, much more secure, and significantly more attractive, especially for large-scale international participants who demand efficiency and safety.
That sounds like a major leap forward in terms of efficiency and, importantly, trustworthiness for global players.
It really is. And alongside that, they've also significantly strengthened their bond trading infrastructure by introducing a central counterparty, or CCP, for clearing fixed income trades.
Okay, CCP. For our listeners, can you break that down? Think of a central counterparty, like a trusted neutral middleman, right? It steps in between the buyer and seller of a bond. It guarantees that both sides of the trade will fulfill their obligations. So if one party were to default, the CCP steps in and ensures the trade still goes through. What does this practically mean for, say, a big international bank trading Mexican bonds? Is it just about trust? Or are there tangible benefits like capital efficiency they're looking for here? How does this impact their ability to actually do more business in Mexico?
That's a great question. And you're right, it's about far more than just fuzzy trust. The introduction of a CCP drastically reduces what's known in finance as counterparty risk, basically. The risk that the person or institution on the other side of your trade won't hold up their end of the bargain. For banks and large institutional investors, this sharp reduction in risk translates directly into lower capital requirements. They don't need to set aside as much of their own capital just to cover the potential losses from a defaulted trade. And when you free up that capital, what can they do? They can engage in more trading, potentially more lending, more investment activity overall. So implementing a CCP acts as a direct accelerator for market activity and liquidity. It makes the Mexican bond market much more appealing, much more functional for these really big global players. And one more piece of the puzzle to make it even easier for these international investors to participate directly, they're also offering colocation services.
Right, collocation. Imagine, as an investor, having your own computer servers, the actual machines that execute your trades, physically located right next to the stock exchange's main servers, sometimes literally in the same data center, maybe even racks apart. This allows for incredibly fast, direct trading of Mexican stocks. It cuts down on those minuscule delays, we're talking milliseconds or microseconds, that can actually make a huge difference in certain types of trading strategies, like high-frequency trading. It's a significant technical barrier removed for those large foreign institutional investors who often prioritize execution speed above almost everything else.
Exactly. It levels the playing field technologically. 2.4, the IPO comeback story, new companies hitting the market. Now, shifting gears slightly, another key factor here is the IPO market initial public offerings. For several years, it was notoriously tough for Mexican companies to go public to list their shares on the stock exchange for the first time. A major reason for this, quite simply, was high interest rates. They were significantly over 10% in Mexico for a while.
Yeah, and that makes perfect sense. If you as an investor could get a guaranteed, virtually risk-free return of over 10% just by buying government bonds, why on earth would you take the risk of investing in a potentially volatile new stock offering, an IPO? It's almost a no-brainer decision. So naturally, investment funds flock to the relative safety and high yield of debt instruments, which effectively starve the equity market of the capital needed for new companies to list.
Exactly. But now that dynamic is fundamentally shifting. Interest rates in Mexico are falling. And as rates come down, companies, especially those with good growth potential, become far more attractive investments relative to bonds. Lower rates also tend to boost company valuations. This crucial change in the interest rate environment is rekindling significant interest in IPOs. The opportunity cost of investing in stocks rather than bonds is decreasing, making equity a much more compelling proposition again for investors.
And there's a cultural element too, isn't there? Historically, Latin America, maybe with the exception of Brazil, which has always had a more developed equity culture, has traditionally preferred debt markets over stock markets. There was often a stronger cultural preference for the perceived stability and guaranteed returns of bonds over the potential for higher but also riskier equity gains.
That's true, there has been a historical preference, but this ingrained preference seems to be noticeably changing now. It's being driven partly by younger generations of entrepreneurs and investors, and also by a new wave of innovative companies, particularly in the burgeoning fintech sector financial technology. We're now seeing more companies that initially grew using private equity funding looking towards IPOs as a viable and attractive exit strategy. This is a sophisticated way for those initial private investors, the venture capitalists, the private equity funds, to cash out, realize their substantial gains from nurturing the company, and then redeploy that capital into their next promising ventures. It really signifies a maturation of Mexico's capital markets ecosystem.
And it seems this cultural shift and the better rate environment are translating into real activity. The sources mentioned that currently there are about 5 companies actively in the IPO pipeline in Mexico. And here's a fascinating detail. Apparently 4 out of those 5 are considering a dual listing. What does that mean, and why is it significant?
Dual listing is really interesting. What's particularly fascinating about this trend is the strategic thinking behind it. These Mexican companies, they want access to the often higher valuations and the much deeper pools of capital typically found in the U.S. stock market. So they list there. But they also want to maintain their strong customer base, their brand identity, and their operational presence in Mexico. So they list there too. It's a sophisticated strategy to try and maximize both their access to international capital and their connection to their local market. They're effectively trying to have their cake and eat it too, leveraging the strengths of both markets.
It sounds like a powerful parallel, in a way, to how American depository receipts, or ADRs, became so popular back in the 1990s. Those allowed foreign companies to effectively trade on U.S. exchanges without a full U.S. listing. This dual listing trend really opens up the possibility of more seamless international trading between the U.S. and Mexican markets, giving investors in both countries much easier access to these dynamic, growing companies.
Precisely. It bridges the markets. 2.5 trade tensions? No problem.
Now, here's something that might seem counterintuitive. You might naturally assume that all the ongoing noise about trade tensions, tariff discussions between the U.S. and Mexico would somehow put a damper on the Mexican market, right? It seems odd to see such robust growth happening against that kind of politically charged backdrop.
It absolutely does seem counterintuitive on the surface. But, quite surprisingly, the market itself and the investors driving it remain remarkably optimistic, almost unfazed by the political rhetoric. They seem to be looking beyond the immediate headlines and the day-to-day noise. They believe that, ultimately, Mexico's undeniable geographic advantage, sharing that massive border with the world's largest consumer market, combined with its deeply integrated manufacturing partnership with the U.S., will solidify its very favorable long-term position. A big part of this optimism is driven by the nearshoring phenomenon we hear so much about. That strategic shift by U.S. and other international companies to bring their production and supply chains closer to home, moving away from more distant locations like Asia. Mexico is seen as a primary, perhaps the primary, beneficiary of this major secular trend.
So the long-term structural advantages are outweighing the short-term political noise, in the market's view.
That appears to be the dominant narrative right now, yes. 2.6. So what does this all mean?
Okay, so let's bring this all together on Mexico. What does this surge, this modernization, this renewed IPO activity, what does it mean for you, our listener? What's the key takeaway here?
Well, if we connect all these pieces to the bigger picture, Mexico is clearly emerging as a really dynamic, rapidly modernizing market. It's proactively upgrading its financial infrastructure to global standards, and it's successfully attracting significant capital, both from local institutions and international investors. It's not just passively riding some global wave. It seems to be actively strengthening its own position, demonstrating resilience even amidst geopolitical noise and trade tensions. So for you, I think it represents a potentially significant opportunity for portfolio diversification. It offers exposure to growth in a key emerging market that's benefiting from major global trends like nearshoring, all while becoming more accessible and efficient for investors. It's definitely a market that's becoming increasingly hard to ignore for anyone taking a global view.
A compelling story indeed. Okay, let's move on to our third topic.
Gold and the Fed. A what-if scenario for your portfolio. Goldman Sachs' bold prediction.
All right, let's pivot now to an asset that's about as traditional as it gets, gold. But we're looking at it through a very modern and honestly pretty provocative lens. Goldman Sachs, one of the biggest names on Wall Street, put out a research report recently sketching out a fascinating what-if scenario. It's one where the Federal Reserve's long-cherished independence might be compromised. Expert, that sounds like a pretty big deal. Unpack this for us. What exactly did Goldman envision happening, and why is the Fed's independence so critical here? 3.1, the Goldman Sachs scenario. When Fed independence is questioned.
Yeah, this report certainly made waves. What's truly fascinating is the chain of logic Goldman Sachs laid out. They envisioned a hypothetical scenario where political pressures, perhaps from the White House or Congress, significantly erode the Fed's independence. This could make the central bank more susceptible to pursuing, let's say, easy money or overly dovish policies, maybe to boost the economy in the short term for political gain, rather than focusing solely on its mandate of stable prices and maximum employment. Now, if that happened, Goldman argued, it could lead to a dangerous cascade of negative economic consequences. Think higher and more persistent inflation, significantly higher long-term interest rates as bond investors demand more compensation for that inflation risk, and just a general pervasive increase in economic uncertainty. Ultimately, and this is the really big implication they highlighted, this scenario could seriously erode global confidence in the US dollar as the world's primary reserve currency. That would be a seismic shift.
Okay, wow. So if that rather dire scenario were to unfold, what's Goldman's so what for the average investor holding stocks and bonds?
Well, their analysis suggests that if such a scenario materialized, it would likely lead to a significant decline in the prices of both stocks and especially long-term bonds. Why? Because the future purchasing power of the returns from those assets would be severely eroded by higher inflation and the general economic uncertainty. Confidence evaporates. In that kind of highly unstable environment, gold, which, crucially, doesn't rely on institutional trust in the same way that government bonds or fiat currencies do, suddenly becomes highly preferred. It's seen as a reliable, tangible store of value. It's essentially a classic flight to safety or flight to quality, where investors desperately seek real assets that are perceived to be disconnected from that potential institutional fragility or political interference.
And this brings us to the headline figure, the number that grabbed everyone's attention for this report. Goldman Sachs suggested that just a tiny fraction, they calculated about 1% of the vast amount of privately held U.S. Treasury bonds were to shift into gold. The price of gold could surge to an astonishing $5,000 an ounce. That is an incredible forecast, dramatically higher than where gold trades today.
It is a stunning number. And just to put that in perspective for listeners, gold recently made a run towards its near all-time high, around $3,500 an ounce, just this week. It's already up over 30% year to date, which is a huge move for gold. Now, Goldman's own base case forecast for gold by mid-2026 is actually $4,000 an ounce. They also have a sort of tail risk scenario, less likely but plausible, reaching $4,500. And then there's this extreme bullish scenario tied directly to that Fed independence erosion, hitting that $5,000 mark. So these aren't just random numbers plucked from thin air. They're derived from a specific, albeit admittedly extreme, economic forecast. It really highlights gold's potential role as a hedge against serious systemic or institutional risk.
Extreme, but based on a logical, if worrying, chain of events. 3.2, the fundamentals supporting gold's potential climb.
Now, it's important to note that even without this extreme Fed independence scenario playing out, there are already some strong fundamental tailwinds supporting gold prices. One of the biggest is central bank buying. Central banks around the world have been consistent net buyers of gold, accumulating significant reserves, basically from 2022 right through their forecast for 2025. This sustained, large-scale institutional appetite creates what analysts call a structural floor under gold prices. It means there's a consistent underlying source of demand that helps keep prices supported and potentially acts as a buffer against significant price drops. It's not just retail investors buying coins, it's major national institutions strategically accumulating gold.
And the sources noted that while the monthly pace of that central bank buying has maybe slowed down a little bit recently compared to its peak, it's still running at a very high historical level. It indicates a continued strong appetite for gold among these major global financial institutions. They clearly see gold as a long-term strategic asset for diversification and stability.
Absolutely. And this brings us to a crucial technical point that explains why Goldman's scenario has such a dramatic price impact. Why would only 1% of the absolutely massive U.S. Treasury bond market moving into gold have such an explosive effect on gold's price? It really boils down to something called market depth asymmetry. Simply put, the global gold market, while it's significant, is considerably shallower, meaning it's much smaller in overall dollar value and daily trading volume compared to the truly colossal U.S. Treasury market, which is one of the largest and most liquid markets in the world.
Okay, let me try an analogy. Imagine trying to pour a large bucket of water into a tiny teacup versus pouring that same bucket into an Olympic-sized swimming pool. That 1% shift from treasuries might be like a single bucket poured into the vast treasury pool. It barely makes a ripple on the surface. But pouring that same bucket, representing billions of dollars, into the much smaller teacup, the gold market, that could cause a huge splash, maybe even overflow the cup entirely. That small amount of money can have a disproportionately huge price impact in the shallower gold market.
That's a perfect analogy. It powerfully illustrates how relative market sizes dictate price sensitivity. A flow that's almost negligible for treasuries can be a tidal wave for gold. 3.3 expert perspectives and counterpoints. A balanced view.
Now, Goldman Sachs, as we've noted, is very clear on their view here. They're labeling gold a high-conviction long trade. They're not just throwing darts at a board, they're putting their considerable reputation and analytical horsepower behind this forecast.
That's right. And it's worth noting that other major financial institutions, like JP Morgan, for example, seem to largely agree with the underlying direction of the argument, even if their specific price targets might differ. The fundamental logic that if trust in the Fed or the dollar is seriously undermined, gold will be heavily favored, and traditional safe havens like treasuries could be shunned, that core idea resonates widely across the financial industry. Gold as a crisis hedge is a well-established concept. However, and this is absolutely crucial for a balanced perspective, we have to consider the other side of the coin, the counter-arguments and cautions. Some analysts argue that gold's price, having already risen so sharply this year, might be vulnerable in the short term to what they call position overheating. Basically, too many investors might have piled into the trade too quickly, making it prone to sudden pullbacks or increased volatility. It could be a bumpy ride.
That makes sense. Plus, the very premise of the Goldman scenario, the idea of the Fed's independence actually being significantly undermined, that's an incredibly complex mix of policy, legal frameworks, and raw politics. Its actual probability, and certainly its precise timing, are highly uncertain. It's not like a simple switch that just gets flipped on or off. It would likely be a gradual, messy, deeply political process, which adds a huge layer of unpredictable risk to forecasting.
Absolutely. That political uncertainty is key. Also, while that central bank buying provides a strong floor, as we mentioned, its monthly pace can fluctuate. It's not guaranteed to continue at the same rate indefinitely. And critically, here's a major potential headwind for gold. If real interest rates, that's interest rates after accounting for inflation, were to rise significantly, or if the US dollar were to unexpectedly strengthen substantially, gold's appeal could diminish quite quickly. Remember, gold doesn't pay any interest or dividends. It's a non-yielding asset. So its opportunity cost, what you're giving up by holding it instead of something else, increases dramatically when other safe assets, like bonds, start offering attractive, positive real returns. Investors might shift away from gold if safer, yielding alternatives become more appealing again.
Right. The opportunity cost is always a key factor for gold. 3.4, what this means for you. Navigating the gold market.
Okay, let's translate this into potential actions or considerations for you as an investor. Looking at the opportunity factors first. Even if you personally assign a relatively low probability to that extreme tail risk scenario of Fed independence erosion, the potential payoff, as envisioned by Goldman, is genuinely huge. It has that asymmetric quality. This makes gold potentially attractive as what traders might call a call option type exposure in a portfolio. You could consider gaining this exposure through various means: owning physical gold, investing in gold ETFs, exchange-traded funds, or perhaps using more sophisticated strategies like options call spreads. Though, given the inherent volatility, using conservative leverage or none at all would be prudent. It's essentially a bet where a relatively small allocation could yield a massive return if that unlikely extreme scenario actually plays out.
And we shouldn't forget the ongoing, consistent net purchases by central banks. That acts as a pretty strong downside buffer for gold, doesn't it? It reinforces gold's traditional role as a portfolio diversifier, a potential shock absorber during times of broader market turbulence or heightened economic uncertainty. It provides a foundational level of demand that's hard to ignore.
Exactly. And in periods where we see rising premiums on long-term bonds, maybe due to inflation fears or policy uncertainty, gold might indeed offer better, more reliable portfolio protection than even long-term government bonds themselves. It can act as a powerful counterweight when traditional safe havens are struggling to maintain their real value. Now, for the risk factors, which are equally important, the biggest one is simply, what if that policy risk doesn't materialize? If those concerns about Fed independence are managed effectively, maybe through existing policy checks and balances or legal mechanisms, then that fear premium that might currently be embedded in gold's price could simply dissipate. That would likely lead to a correction in gold prices as the market decides the worst-case scenario isn't going to happen after all.
And conversely, thinking about the economics, if inflation cools down more rapidly than expected, or if the US dollar unexpectedly strengthens significantly, that opportunity cost of holding gold again, the asset that yields no interest, could increase substantially. That would put downward pressure on its price as investors naturally look for higher-yielding alternatives elsewhere in the market. Gold typically underperforms in strong dollar, rising real rate environments.
Precisely. And finally, just to reiterate, because gold has had such a rapid run-up recently, it is inherently susceptible to sharp, volatile price swings, especially during periods of lower market liquidity or heightened uncertainty. This means you need to be prepared for those ups and downs if you hold gold. Managing your position size and having a clear understanding of its inherent volatility are absolutely key. It's not typically a smooth ride.
Right, point five.
So, what does this all mean?
Okay, so putting it all together on Gold Expert, thinking about the potential $5 case scenario, the central bank buying, the risks, what's the ultimate takeaway for our listener from this fascinating yet perhaps a bit concerning Goldman Sachs outlook?
Well, Goldman Sachs' scenario provocatively links gold's traditional strengths, its role as a store of value, its independence from institutions, to very significant contemporary political and institutional risks. It suggests the potential for truly extraordinary gains resulting from even a relatively minor shift of capital out of traditional financial assets like treasuries, if that specific risk materializes. However, for you, the investor, the key takeaway is really about disciplined positioning. It's about carefully managing both that potentially massive upside exposure from an extreme but perhaps plausible event, and acknowledging and managing the very real risks associated with policy uncertainty, shifting economic conditions like real rates and the dollar, and gold's inherent market dynamics and volatility. It's undeniably a high-stakes, potentially high-reward proposition right now, and it demands really careful consideration and strategic allocation within a diversified portfolio. Not something to jump into blindly.
Discipline and awareness.
Got it?
Okay, one more major topic to cover today, and it also involves gold, but in a very different way.
The future of gold. Going digital, the World Gold Council's vision.
We've just explored how big picture things like institutional trust and global capital flows could dramatically impact gold's future price. But let's now explore an even more radical idea, something happening within the gold market itself. What if gold, this ancient physical, tangible store of value, became truly digital? The World Gold Council, or WGC, which is a key industry body representing major gold producers, has announced a groundbreaking new initiative, a structure called Pooled Gold Interests, or PGI. What is this all about? 4.1. Introducing Pooled Gold Interests, PGI, Gold's digital makeover.
Yeah, this is a really interesting development. What's truly fascinating here is that PGI is designed specifically to allow for fractional ownership of physical gold bars, but in a digital format. So imagine owning a tiny digital token or certificate representing a specific share of a much larger securely held gold bar, like a 400-ounce London Good Delivery bar, all stored safely in a highly trusted, accredited vault. The whole system operates under a robust trust framework, which is shared and managed by key established players in the gold market, like the major gold producers themselves and the specialist vault custodians. The aim is to ensure transparency, security, and integrity from the mine right through to the digital representation. It's a significant modernization effort for a very old market. And this PGI model is being positioned as essentially a third settlement structure for gold, sitting alongside the traditional ways people own gold. It's designed, in theory, to combine the best aspects of allocated gold, where you technically own specific individually identified gold bars, and unallocated gold, where you essentially own a claim against a general pool of gold held by a bank or dealer. But, and this is the critical part, it aims to eliminate many of the operational complexities, the physical logistical challenges, and importantly, the credit risks that have historically been associated with those traditional methods. The goal is to make gold transactions smoother, safer, and far more efficient, especially in our increasingly digital age.
Okay, so it's about making ownership easier and safer. But crucially, PGI isn't just about passively owning digital gold, is it? It's also about utility. The sources say it's designed to facilitate digital payments and, maybe even more significantly, to be used as collateral in financial transactions. So your digital gold wouldn't just be sitting there statically in a digital vault. It could potentially be actively used within the broader financial system, much like other digital assets or traditional securities are used today.
That's the vision, absolutely, making gold a more active, usable asset. 4.2, the vision and timeline, making gold more dynamic. So how quickly is this happening? Well, the WGC plans to launch a pilot program for this groundbreaking PGI model in the first quarter of 2026. So it's not immediate, but it's on the near horizon. And importantly, this isn't just some small, quiet internal trial. They're specifically targeting the London OTC, that's the over-the-counter gold market for this pilot.
Right, and just to remind our listeners, over-the-counter, or OTC, means transactions happen directly between large institutions, like banks and bullion dealers, rather than on a formal, centralized exchange. This is where the vast majority of large-scale institutional gold trading takes place globally. So piloting PGI here means they're directly targeting the very heart of big gold transactions and the largest, most influential players in the market right from the start.
Exactly. And that choice of location, London, is no accident either. London is, without question, the world's largest and most important physical gold trading hub. We're talking about an astonishing estimated annual trading volume of around $900 billion passing through the London market. So the ambition here is that by digitalizing key aspects of this immense market, they can significantly enhance its trading efficiency, potentially improve overall market stability, and dramatically increase transparency for participants across the entire global gold market. It's not just a minor upgrade, it's potentially a foundational change with truly global implications if it succeeds.
$900 billion annually. The scale is just immense. 4.3, the tech backbone. Building on trust and transparency. Now, this PGI concept, it isn't just a brand new idea appearing out of thin air, is it? The sources indicate it actually builds on existing robust technology that the WGC has already been developing. They have something called a gold bar integrity program, which apparently leverages blockchain technology. How does that fit in?
Right. Blockchain, in this specific context, is being used essentially as an immutable, highly secure, transparent digital ledger. Think of it as providing a verifiable, tamper-proof digital passport for each individual gold bar that's part of the program. It tracks the bar's origin, which mine it came from, its verified quality and purity, and its entire chain of custody every time it changes hands throughout its life cycle. This isn't just about tracking where it came from, it's fundamentally about building an unassailable chain of trust and quality assurance. This significantly enhances transparency and aims to reduce risks like fraud or the inclusion of improperly sourced gold, which are critical concerns in a market dealing with such high-value, physically backed assets. And PGI itself is actually just one of three core pillars of a much larger, even more ambitious WGC initiative called Gold 247. The other two pillars are that gold bar integrity program, the blockchain tracking system we just discussed, and something called a standard gold unit, which aims to establish a globally consistent digital standard representing, say, 1 gram of gold.
Okay, so the grand vision here isn't just about PGI as one new product. It sounds like they're aiming for a complete digital transformation of the entire gold market infrastructure, literally from the mines where the gold is produced, all the way through to how it's refined, vaulted, traded, and ultimately used in finance. It's like they're trying to build a whole new set of digital plumbing for the global gold market.
That's a great way to put it, a complete infrastructure overhaul for the digital age. 4.4, market buzz and skepticism, two sides of the coin. Now, as you might expect with such an ambitious plan, there's quite a bit of buzz, but also some healthy skepticism. Proponents, particularly the WGC and its allies, firmly believe that initiatives like PGI can fundamentally transform gold. They want to shift it from being perceived primarily as a non-productive asset, meaning it just sits there and doesn't generate income like a stock dividend or a bond coupon, into a truly usable asset within the modern financial system. This shift in perception and utility is potentially a game changer.
Right. And usable in this context means gold could play a much bigger, more dynamic role as high-quality collateral, for instance. Imagine easily using your digital gold holdings to back loans, or to meet margin requirements in derivatives trading, or as part of other complex financial instruments. It moves gold from simply being stored passively in a vault to actively participating in day-to-day financial transactions, effectively unlocking its latent economic value.
And for the big players, the banks and other large financial institutions, this could represent a significant structural improvement to how they operate. It could allow for much better, more efficient risk management. It could streamline the often cumbersome process of meeting margin calls, those urgent demands for additional collateral during volatile market periods. And ultimately, it could lead to a more efficient use of their overall capital. It essentially integrates gold much more seamlessly into their existing digital workflows and capital management operations.
Okay, that's the optimistic view. But not everyone in the traditional gold world is necessarily convinced, are they? The gold market is notoriously conservative. It's a very old market, steeped in tradition, with deeply ingrained habits. There's bound to be some inherent resistance to change, right? I can almost hear some old-school bullion dealers in London sipping their tea and raising a skeptical eyebrow at the mention of blockchain for gold bars.
That resistance is definitely real. And that very conservatism, that inherent skepticism towards rapid change, isn't that ironically both gold's traditional strength, its stability, its perceived timelessness, and potentially its Achilles heel in a global economy that's digitizing at lightning speed? Some seasoned experts even question whether such fundamental structural changes are truly necessary or even desirable for gold, especially given that, as we discussed earlier, it's already been one of the best performing assets recently without these digital bells and whistles. The argument you sometimes hear is, if it ain't broke, don't fix it. This points to a deep-seated caution within parts of the industry, which can either be seen as prudent risk management or potentially as a barrier to future growth and relevance. It's a real tension.
A classic tension between tradition and innovation. 4.5. Your takeaways as an investor. What this means for your portfolio.
Okay, let's boil this down for you, the investor. What are the potential opportunity factors here with digital gold? Well, PGI and initiatives like it hold the genuine potential to make gold much easier to access for a wider range of investors, potentially simpler and cheaper to trade, and certainly more versatile to use as collateral within the financial system. This increased utility and potential for greater liquidity could fundamentally be a long-term positive for gold's role in global portfolios. It's not just about owning it, it's about what you can do with it.
And that greater accessibility and enhanced utility could, over time, significantly strengthen the overall demand structure for gold, couldn't it? It could move gold beyond being seen primarily as just a niche, safe haven, crisis-driven investment towards becoming a more integrated and actively used component of global finance. That could potentially attract a broader base of investors who might have previously overlooked gold due to its physical nature or lack of yield.
That's the hope. And if this digital gold framework really gains significant traction globally, we might even start to see new types of investment products emerge. Perhaps we'll see specific premiums develop for ETFs that track digital gold, or new kinds of gold-backed financial products like derivatives, DVRs, or exchange-traded notes, ETNs, that offer sophisticated new ways to gain exposure to gold's price movements, potentially with added features enabled by digitalization. Okay, now for the risk factors to keep in mind. It's really important to remember that the London pilot program starting in 2026 is just the very beginning. The pace at which this digital gold framework actually expands globally and gains a widespread adoption among major institutions could be much, much slower than proponents anticipate. Institutional change, especially in such a deeply traditional, globally fragmented market like gold, often moves at a glacial pace. There are huge hurdles to overcome.
Exactly. Changing deeply entrenched institutional infrastructure, aligning regulations across different countries, getting buy-in from thousands of market participants, it takes immense time, coordination, and significant investment. The real-world flexibility and the ultimate level of widespread adoption might not fully match the ambitious initial plans. There's almost always a significant gap between the grand vision and the messy reality of seamless execution, especially in finance.
So, given these dynamics, the potential upside, but also the uncertain timeline and execution risks, you might consider, down the road, a more segmented approach in your portfolio. Perhaps thinking about a traditional physical gold versus emerging digital gold strategy. This could allow you to optimize your risk and reward exposure as this market slowly evolves, essentially hedging your bets on the speed of adoption and the eventual success and final form of these digital gold initiatives.
And of course, it almost goes without saying, keep a close eye on the PGI implementation schedule, the results of that London pilot, and critically, how all of this interacts with the much broader global landscape of things like central bank digital currencies, CBDCs, and constantly evolving financial regulations. This digital gold push isn't happening in a vacuum. It's undeniably part of a much larger global digital transformation of money, assets, and financial infrastructure.
Absolutely essential context. 4.6. So, what does this all mean?
Okay, expert, last wrap up for today. What stands out to you here as the most critical takeaway for our listener regarding the World Gold Council's ambitious digital gold initiative? What should they really be thinking about?
Well, the WGC's Digital Gold Initiative, particularly PGI and the broader Gold 24/7 vision, is undeniably a significant and highly ambitious step towards modernizing the very traditional, often opaque, global gold market. It holds genuine transformative potential. It could redefine aspects of global liquidity and dramatically enhance gold's utility in modern finance, making it more relevant to a new generation of investors and institutions. However, and this is a big however, its ultimate success will absolutely hinge on a complex interplay of factors. The actual speed of adoption by a notoriously conservative market, the ability to achieve seamless legal and technological integration across many different jurisdictions, and frankly, its ability to overcome the deep-seated market inertia and resistance to change. It's truly a fascinating experiment playing out at the very intersection of ancient forms of wealth and cutting-edge future technology. It's definitely one that bears close watching over the next few years.
Ancient wealth meets future tech. A perfect summary. Outro. Wow. Okay, that was quite the journey today. What an incredible deep dive across four really distinct but, as you've shown, interconnected topics. We started by navigating that intense competition and the tricky regulatory tightrope walk among the giants of the AI world, watching them play that high-stakes, constantly evolving chess match. Then, we journeyed south to uncover the surprisingly vibrant and rapidly modernizing Mexican stock market, exploring the powerful forces both global and local that are fueling its impressive surge. From there, we delved into that truly fascinating, almost alarming, what-if scenario for gold prices, driven by the profound potential implications of central bank independence being challenged. And finally, we looked at the equally ambitious plan to bring gold, perhaps the most ancient of financial assets, squarely into the digital age with initiatives like PGI.
And as we said at the start, these seemingly disparate topics, AI, Mexico, the Fed's role, digital gold, they are, in fact, all essential threads in the same rapidly evolving tapestry of our global economy. They show us vividly how innovation in areas like AI is creating entirely new forms of value and power, how global investment flows are constantly reshaping market landscapes, how fundamental concepts like institutional trust remain crucial, underlying factors, especially for traditional assets, and even how the very nature of money and assets themselves is being reimagined in this digital era. Understanding these intricate connections, seeing the patterns rather than just isolated facts, is truly key, I believe, to making sense of our increasingly complex economic world.
Absolutely. So here's something maybe to roll over as you go about your day, a final provocative thought building on all this. As artificial intelligence continues to reshape entire economies, maybe even the nature of work itself, and as traditional tangible assets like gold become increasingly digital and integrated into the financial system, what does that ultimately mean for how we, both individually and collectively, understand and even define value itself in this rapidly changing, deeply interconnected world? Is value becoming more abstract or perhaps paradoxically more accessible? Something to think about. We really hope this deep dive has given you some valuable insights, sparked your curiosity, and maybe even changed how you look at some of the headlines flying past you. Keep exploring, keep asking questions, and most importantly, keep digging deeper.